Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name is Zhong, and welcome to Through the Noise podcast. We have shared before that September has historically been weak for stocks. While there are still 2 more trading days left to go for September, it appears that equity markets have beaten seasonality for now. S&P 500 has posted several all-time highs in the process as well. A likely driver for this is the commencement of Fed rate cuts cycle last week, adding to the long list of central banks who are already cutting. Naturally, one would ask, how to position for a world of falling rates, which is what we focus on in this month's Global Market Outlook. To discuss in detail, I've invited a familiar face on this podcast, Manpreet Gill, our Chief Investment Officer for Africa, Middle East, and Europe. Welcome, Manpreet. I'd like to start off with the macro outlook. With several major central banks now in monetary easing mode, what does it mean from an economic perspective?
Hi, Jong. Thanks for having me on. You're right. I think the big macro theme is that major central banks, of course, are in easing mode, and the big one, of course, is over the past month we had the Fed join in cutting rates. Now, for the US, we think the biggest theme is that it makes a soft landing outlook much more plausible, much more likely, as indeed the Fed managed to achieve in the mid 1990s. So we still see about a 60% chance of the soft landing environment continuing for another 6 to 12 months. And a lot of our market views are centered around that. We do see that balanced by a not insignificant 25% risk of a recessionary outcome, but we see that as more of the risk scenario that, of course, warrants ongoing monitoring rather than something to worry about too much. Now, while the US economic outlook, of course, remains arguably one of the most important ones for financial markets globally, there are a few other themes, macro themes, we are keeping an additional watch on as well. The first, of course, being the announced policy stimulus measures in China. We do believe that the latest boost improves the chances that the economy does achieve its stated growth targets. The second one is arguably nascent signs of exuberance in some pockets of Indian markets, particularly what we're seeing in Indian small caps and IPO markets. But we do believe these are still quite focused and narrow and unlikely to hurt broader equity market gains, given we're still getting strong earnings growth. And finally, of course, geopolitics and oil prices. There are always some storm clouds on the horizon, but we do expect oil to stay in a relatively tight range around $70 per barrel, which, of course, from a macro perspective, should limit downside risk to the global economy.
Well, now that we have set the context, I would like to go back to the question I raised actually in the intro. How to position, right, for a world of falling rates?
No, it's a great question. And actually, in a world where rates are falling, I wanted to start the answer to your question by talking about cash. Because yields on cash have been, unusually attractive over the past 2 years. They've been amongst the highest we've experienced in 2 decades. But clearly, this period now coming to an end. Money market expectations and indeed the Fed's own projections argue that cash yields are likely to move significantly lower over the coming 6 to 12 months. And that is why we think an underweight view is warranted on cash. And we expect equities and bonds both to outperform any cash yields from here. Now, if you start with that sort of cornerstone, if not cash, then where else do you go? One is bonds. We've previously highlighted, of course, that bond yields have historically moved lower as the Fed kicks off a rate cutting cycle. So the opportunity today, in our view, is to add exposure on any rebound in US bond yields towards 4% on expectations that the Fed rates and bond yields will continue to fall from here. Now, this, of course, would be more directly positive for government bonds, but corporate and EM bonds should benefit from that down move as well. And we think, of course, this sort of fall in yields can help offset some of the lack of value we're seeing in some parts of the corporate and EM bond market. Overall, we have a fairly balanced view across major bond asset classes, particularly since we've also just closed the overweight on EM US dollar government bonds after what's been some strong performance recently. Now, that's, of course, on bonds, but if you have a soft landing view like we do, then, of course, that outlook is supportive for equity markets as well. In our view, the avoidance of recession in the US should help keep earnings growth well supported and hence support further equity market gains. Now, this is arguably a fairly US focused argument. The US market is where the earnings outlook remains strong, where rates have significantly further room to fall, and of course, where the sector composition remains a bit more rate sensitive than peer markets. That's why we, within equities, remain overweight on US markets. Now, over in Asia, in China, the policy support measures we just discussed, in our view, are supportive for equities in the short term. So while we maintain our neutral or core holding view on a 6 to 12-month horizon on Chinese equities, we do believe further near-term equity momentum is likely, given the starting point is one of reasonable valuations and uncrowded positioning. I think the key question here is whether we get any follow-up policy support, because if we do, that of course would help offset some persistent deflationary and geopolitical worries, and hence improve the 6 to 12-month view. Within Asia for now, though, the one market we remain overweight is India, within Asia ex Japan. This is a market where the growth outlook remains most robust. And while there are some signs of pockets of froth, as we just discussed, broader market valuations do remain below their peaks. And therefore, we think an overweight to Indian equities relative to Asia ex Japan remains warranted.
Gold remain a key weight for us in our level one asset location. Could you just share a little bit more on the rationale behind it?
Absolutely. And I think you're right that while we discuss the underweight in cash, core holding views in equities and bonds, it's gold is where we remain overweight. Now, in our view, gold prices do have room to rise further, and bond yields, what we discussed in bond yields, are one driver of this. If the rebound in bond yields remains relatively short lived, as we expect, the opportunity cost of holding the non yielding precious metal should continue to fall, which of course is a support for gold prices. The other factor supporting gold prices is central bank demand. Here, both purchase data as well as the broader macro geopolitical environment argue that this positive momentum to gold prices has room to continue. So overall, on balance, that's why we are overweight on gold, and we have once again revised our 12-month price expectation higher to $2,800.
Or not forgetting the opportunistic allocations, what are the key changes for this month?
Well, I think some interesting ideas as always, and you're right. I think this is a good point to remind our listeners that a lot of what we just discussed, of course, is how we think about the core foundation allocations, and of course, opportunistic ideas can be an attractive layer on top of that, with a more focused calls to hopefully help generate additional returns. Now, this quarter, of course, we've had some strong gains in bond markets. So we have taken the opportunity to close a few of our bond ideas. So one is we've closed our 20-year US Treasury opportunistic idea. These bonds have, of course, outperformed the rest of the curve in recent weeks. So we just believe it's a good opportunity to take some profit there. We've also closed our China US dollar bond idea, which has also performed well, but we think that performance, of course, means value has eroded to some degree. Overall, though, that leaves us with four open ideas. That's, of course, on global convertible bonds, US agency mortgage-backed securities, Euro area government bonds on an FX hedge basis, and Indian rupee onshore bonds. The common theme here, of course, a lot of these linking them is that we see them as pockets of value in a bond market that otherwise is one where yield premiums are fairly tight. In equities, though, there are no changes. So all our existing ideas remain open. So what that means is in the US and Europe, we have opportunistic buys on the US technology, communication services, and major bank sectors. We, of course, also like the healthcare sector in the US and Europe. And over in Asia, our top opportunistic calls are in Chinese non-financial high-DV state-owned enterprises, Indian large-cap equities, and Japanese banks.
Or if I could sum it all up, the start of the Fed rate cutting cycle supports our view that the US economy would achieve a soft landing, and amidst this, gold is likely to be a key winner, while cash could be the biggest loser from lower rates. On the bonds, we would add to high quality bonds within our foundation allocation on any rebounds in government bond yields towards the 4% handle. Of course, equities, particularly in the US, should also do well within in the soft landing scenario. Thank you, Manpreet, for the detailed sharing. Thank you to our listeners for your kind attention. That's all for this week Through the Noise podcast. Have a good weekend ahead. Cheers.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.